This video is for educational purposes only and should not be considered financial advice. Two major consolidation traps to watch out for. In this video, we will show you two major consolidation traps to watch out for in trading and a few ways you can avoid them. Consolidation types. When price consolidates, it does so in several ways: normal consolidation, contracting price consolidation, and expanding price consolidation. Normal consolidation. The normal consolidation is when price creates a parallel channel. Some people can trade these channel consolidations very successfully. The other two consolidation models are a bit more trickier to trade. Contracting price consolidation. When price is contracting, this is usually called a pennant pattern. The outside ranges of price continue to get smaller and smaller to where price expands in one direction to continue or reverse from a move. Expanding price consolidation. When price is expanding, this is when the outside ranges continue to get larger and larger until price continues or reverses from the previous move. Contracting price is not as dangerous as expanding price. When price is contracting, you may place a trade and then wait for a long time for price to either go in your direction or stop you out. As we can see in this example, price contracted and then stayed in that contraction for a long time. Then it broke out around here and retraced to create an entry. You could have entered around the 50% of this order block, or if you wanted to wait, you could have waited until this fair value gap was closed right here, and that could have been an entry. But again, you still have to wait. And then price moves to the downside. There is another entry here where price fully breaks outside of this channel and consolidation, retraces, and then closes outside of this impulse movement, clearly making the case that it's not going back into this fair value gap. This could have been an entry here. Expanding price consolidation will create false hope of a large move in one direction and then head back to take out your stop. It is advisable to move your stop loss to profit or break even sooner rather than later when trading expanding price action. As you see, price is expanding, and then this move gives traders false hope that we're moving to the downside. It is definitely a displacement, and when price retraces back up into this order block, you might be tempted to take an entry. And if you do, move your stop loss to break even once you're in profit. That way, as in this case, price reverses and heads toward your stop, you would not have lost on this trade. Ways to stay out of consolidation traps. Look on a higher time frame. If fair value gaps are being disrespected both ways, price is consolidating. Wait for price to move out of a range with displacement. Looking on a higher time frame. Price is fractal and can give you a clue as to how it will consolidate. As we see on this 1 hour chart, price is expanding, and then inside of that expansion on a 5-minute chart, you have another expansion. So knowing that price is expanding on a 1 hour chart, as you see highs are taken, the lows are taken, highs are taken, then you can surmise that highs and lows will continue to be taken out. This is tradable, but again, you have to use caution because you don't know when price will start to make its move. If you were watching price at this point in time and you saw price take a high, then take a low, and then move up to take a high, you could probably guess that it's going to take a low once it closed inside of this candle. And that happened here. Once this candle got engulfed and closed below, you could look to make an entry inside of this fair value gap and head for the lows right here. If fair value gaps are being disrespected both ways, price is consolidating. So when price creates a fair value gap, it means that there is enough volume to push price in that direction. If it retraces the full length of the fair value gap and closes beyond the 50% level, then most likely it is a false fair value gap and will reverse. As we see in this example, we have an opening gap and then price hits this level and creates a channel. The fair value gap here and this fair value gap here are now being disrespected. Price is closing inside of this fair value gap, and then price breaks down. Price makes its move and closes inside of this fair value gap, creating bearish fair value gaps, which you might think that price is moving on the downside. However, with one candle, it disrespects all of these fair value gaps. And then not too long afterwards, it disrespects this fair value gap created by coming in to the 50% level and going all the way down to almost the full length of the candle. Let's look at some examples. As we see in this example, we notice we have this fair value gap. These were wiped out. This one got wiped out as well. And this created a fair value gap right in this area, this downward move. Price bounces off the bottom of the channel, and we're looking for a move back into that fair value gap. We see price respects it here, then starts making a move downward. Now you might be tempted to enter, but again, we have to look at context. This is the NASDAQ 100 during the Asian session. So you want to wait till the New York session, or at least wait till London to start trying to trade the NASDAQ 100. The London session begins, price returns back to that fair value gap, respects it again. It created a fair value gap on the way to it. This is a bullish fair value gap. This bullish fair value gap got disrespected. Price closed inside of it, closed below it, creating a bearish fair value gap that now is being respected. And you can enter around here once you see price has moved away from this fair value gap. Wait for price to move outside of a range with displacement. Usually when consolidation traps happen, they have been inside of a range to give false hope to traders that it's going to break out of a range in one direction, but actually it will move in the other direction. So here we have a range, and then price breaks out with displacement, but this is not a large displacement. Plus, this happens right at the beginning of the New York session. Then price shoots back up in the other direction with huge displacement. That is your cue that we're moving to the upside. Price retraces back into this fair value gap to around the 50% level. It taps this order block, and that is your entry. Once price shows a willingness to move away from this order block, you can enter on this candle and catch the move up to take out this liquidity. To recap, being able to spot consolidation traps is key to avoiding massive losses in your trading account. Always look at the larger and smaller time frame context of your chosen trade. Make sure you are not using trend trading techniques in consolidations, and wait for displacements and open fair value gaps to start looking for trends. If you found this video helpful, please like and subscribe for more videos like these. Also, please leave a comment if you have any questions or if you have any other video suggestions. Thank you for watching.